Hello and welcome to the last session of this hall. I welcome you all to a critical session for a keynote address on alternative data and relevance in the post-COVID world. For this address, I have the pleasure of inviting Mr. Mahesh Uttam Chandani, Global Practice Manager of Finance at the World Bank Group. Mr. Uttam Chandani, the stage is yours.
Thank you very much, and good afternoon, good evening to everybody. Good morning from here in Washington, D.C. And I understand that I'm what stands between all of you and the end of the day. So thank you very much for joining. And it's my pleasure to be here. And thank you very much to the organizers. First off, let me say to everybody who's connected, I hope you are faring well in these rather difficult and uncertain times that we are living in. And grateful again for you joining today. As you will all no doubt know, the COVID-19 pandemic started as a health pandemic and continues in that regard, but it is evolving in many parts of the world into a financial crisis, and in many cases is exposing existing financial sector vulnerabilities that were present before this crisis hit, but are being exacerbated by the crisis. And so the world is now grappling with at least two crises that are proceeding simultaneously. One that requires us to save lives, and one that requires us to save livelihoods. An estimated 14.7 million people have been infected globally, with 611,000 deaths as of yesterday. And in many jurisdictions, there are fears of a second wave of the crisis. And part of the government response to this in countries around the world has been instituting lockdowns and social distancing measures, as well as the closure of non-essential businesses. And these measures have been critical for safeguarding health and safety, but a natural result of these measures has been the disruption of real and financial economies in a way that doesn't really have much precedent in our lifetimes. And the pandemic is disrupting credit markets as many small businesses go out of business, people lose their jobs and sources of income, and are unable to repay their credit obligations or access credit and finance to meet their needs. Businesses are also suffering from a decline in aggregate demand and curtailed operations, which is threatening their viability and solvency. A recent study that we conducted here at the World Bank suggests that globally, businesses have between 12 and 38 weeks of liquidity to survive an absolute shutdown in their business. Obviously, in some jurisdictions and with some businesses, it will be much less than that. And in some cases, it may be a little bit more. But we are rapidly approaching the mark where most businesses cannot withstand an absolute shutdown of their business, their operations. And a recent National Bureau of Economic Research paper that surveyed 6,000 small businesses, admittedly here in the US, found that 43% of businesses had already closed since the crisis hit in January. And on average, these businesses reduced employment by 40% since the beginning of the year. And more than 2/3 of these businesses had less than 2 months of cash, so 8 weeks of cash to operate during the crisis. So borrowers that have historically met all of their credit obligations are, in the context of current crisis, likely to fail on many of those obligations due to a loss of either income as employees or revenue as business owners and operators. And investors, against this background, are searching for an information advantage and really are demanding higher frequency data and increases in data availability. And that's really where we come to this discussion that I was asked to speak to you about today on alternative data and credit markets in a COVID and post-COVID environment. And in the absence of accurate and timely data, credit providers tend to adopt a much more cautious lending approach and look inwardly to their existing customers, which further constrains access to credit by traditionally marginalized groups such as MSMEs, firms operating in the informal sector, firms led by women, and individuals and households in the rural parts of countries. And we know historically that data inadequacies will impact recovery prospects because it will inhibit firms from expanding and growing during what we hope is an accelerating growth period out of this crisis. So if we think about traditional sources of credit data and their limitations in an environment like this, we know that credit providers traditionally rely on credit data repositories, your credit bureaus and the like, for creditworthiness assessment. And investors rely on national statistics to grow their portfolios. And these data sources have been significantly disrupted by the pandemic because of a number of reasons, including difficulties in the collection of national data, because the crisis has significantly disrupted national statistics such as inflation figures, which tend to be collected through administering surveys. Now, some governments have been able to use digital platforms such as online surveys or even phone calls, but many in emerging markets and developing economies have not been able to publish key indicators. According to Bloomberg, as at the beginning of June 2020, several very large emerging markets had not published key national statistics. That's one issue. Another issue is the time lag. Home-based work has increased the time lag in the release of traditional data. So national statistics have had additional lags ranging from 3 weeks to several months, depending again on the digital data collection capabilities. Credit reporting services have not been really able to keep pace with this pandemic, and some of their data providers have had challenges in submitting data in a timely way. Another challenge has been incomplete data. So delays or non-submission of data has impacted the integrity of data in public repositories. Frequency has been another challenge. So the disruption of operations has impacted the frequency of data reported, and we know historically that frequency is something that credit providers rely on. There are other issues like inconsistencies in data computation. And we know looking forward that there is a growing risk, which is the failure to implement safeguards or accurate reporting codes in the treatment of credit data. For example, those who have not paid because of a mandated credit holiday or period of non-enforcement that's been mandated. And these might have a long-lasting impact on the ability of borrowers to access credit post the crisis. And that's something we really need to keep our eye on collectively. Now, mindful of these limitations, the actors in this space are searching for alternative data to complement traditional data. And some credit providers have started experimenting with alternative data long before the crisis. And we are all coming to realize that using alternative data is no longer a luxury, and it may in fact become a necessity. So there are many definitions of alternative data. We look to the definition put out by the standard setter in this space, the International Committee on Credit Reporting, which I have been privileged to be the chair of for the last several years. And the ICCR is the standard setter on credit reporting, and we view alternative data as serving to describe ways to collect and analyze data on creditworthiness, which are alternative to conventional methods, such as those in a documented credit history. So it's a very wide definition. I think we need to start in the same way that we have differing understandings of what terms like fintech mean, or even what a term like SME or MSME means. We have to recognize that there is a very wide definition for alternative data. And every time individuals or SMEs browse the internet or use their mobile phones or engage in social media, use e-commerce platforms, even ship packages or manage their record keeping online, they create digital footprints which lenders can use for creditworthiness assessments. The proliferation of big data and the emergence of technological innovations such as artificial intelligence and machine learning makes it easy to mine and analyze vast amounts of data. And so alternative data can be broadly categorized into structured and unstructured data. And these two sources can generate quite a bit of data used for decision making. Now, despite the wealth of big data available, not all data is good and useful for creditworthiness assessments. Good data, in the view of the ICCR, and certainly in our experience at the World Bank, should include several elements. Coverage, right? So data sources should cover a broad proportion of the population and ensure enough comparability across data subjects. Regulatory compliance. So the collection, processing, and distribution of data should comply with regulations, including critically data privacy regulations. This data should have predictive power. So although it might comply with regulations, it's most important that it is in fact predictive and it tells us something meaningful about the creditworthiness of individuals. But it needs to also be mindful to avoid possessing discriminatory traits. And that for that reason, the transparency of the technology becomes critical. Alternative data should also be available, should be cheap and easy to mine, obviously should be accurate, and it should provide sufficient detail or depth of information. Once this is established, the use cases of alternative data can be many. Policymakers use, for example, epidemiological and GPS data to influence policy. GPS data has been used for contact tracing, of course, in the context of this crisis, and to identify the location of beneficiaries of government grants. So private sector players such as bureaus are partnering with development finance institutions, such as ourselves at the World Bank and others, to develop tools such as COVID ratings to assess firms' financial resilience and solvency. And these tools are also designed to assist in triaging responses to address the challenges that firms are facing. Now, we have to be mindful of the risks of using these new data sources, and the adoption of alternative data does raise risks that need to be mitigated to make sure the data is used responsibly. Key risks include data inaccuracies, again, data that is based on prejudices or biases, or in fact, even uninformed consumer consent. The use of alternative data is also susceptible to the risk of promoting access to credit in new customers and marginalized segments that needs to be balanced with the attendant consumer protection policies that would be put in place. Now, our role as a leading international development institution has been fairly widespread in this context. We've been actively working to promote the use of alternative data for creditworthiness assessments, particularly for unserved and underserved segments of the population. And our work in this space has included standard setting, technical assistance programs for implementing alternative data projects, piloting and innovation with alternative data, and of course, disseminating knowledge and information about what experiences have worked and what has not worked in the use of alternative data. And the World Bank is actively supporting the efforts of emerging markets and developing countries to develop alternative data solutions. In the standard setting space, the ICCR issued in 2018 a policy guide on the use of alternative data for creditworthiness in the context of the G20's Global Partnership for Financial Inclusion. The policy guide offers 21 practical policy recommendations on how countries can adopt and leverage the use of alternative data for credit reporting while mitigating the risk inherent in the use of such data. And the recommendations are categorized into 8 policy areas, which include improving the availability and accuracy of information, expanding credit information sharing, enabling cross-border data exchanges, balancing integrity, innovation, and competition, preserving data privacy and consumer protection, balancing opt-in and opt-out models, safeguarding cybersecurity and data integrity, and maintaining pricing transparency. All of these 8 areas we believe to be critical to a successful implementation of an alternative data framework for credit reporting. And there are several alternative data pilots or projects underway globally, which we have been proud to be part of, and some of which offer some interesting insights into how alternative data is being used. One that I'm particularly excited about is the Women's Entrepreneurship Development Program in Ethiopia, which had as its objective to support the entry and growth of women-owned businesses using alternative data and other data sources. And this was particularly important if we think about the access that women have and women-owned businesses have to finance, which lags significantly behind men. And we need to think about alternative policies that really harness the power that women-owned businesses can bring to the market, and how to effectively bring these to the market, not just in a post-COVID environment, but in a traditional environment that uses alternative data. So in Ethiopia, women-owned businesses faced several constraints, including being excluded from credit bureaus, not having traditional collateral to pledge as security for a loan, which limited access to finance, often the lack of formal identification for women, and even limited ownership of mobile phones. And so women have often been overlooked as a viable business segment by banks. We worked with policymakers in Ethiopia and with development partners to develop alternative data-based scores to make women more credit visible. And in the end, one of the things that proved to be highly effective was the use of a psychometric scoring model. A psychometric scoring model analyzes a person's personality traits, their responsibility, their honesty, their self-control, their impulsiveness, for the purpose of determining creditworthiness. And it proved to be highly predictive of credit risk, particularly for women who did not have heavy credit files or a great deal of credit bureau payment history. We worked with microfinance institutions that participated in a pilot through this program to help in 4 regions and 10 cities, and to leverage seed funding of about $140 million, which was raised with many development partners, including DFID in the UK. And the result was that 12,500 loans, totaling approximately 125 million US dollars, was generated for women-owned businesses, 2/3 of whom were first-time borrowers. And looking at that portfolio, it has less than 2% arrears, and is not dependent at all on heavy coverage of collateral for loans. So this is an example of how alternative data can be harnessed to reach underserved and unserved groups and provide an alternative to traditional lending models. We're also engaging in another pilot in South Africa, the objective of which is to promote the extension of credit to MSMEs, again, with no credit histories or limited credit files, using alternative data. And of the 5.78 million SMEs in South Africa, only 14% are formal. And of these, more than 22% are credit constrained, with a finance gap that's estimated at 30 billion US dollars. And many of these firms are invisible, again, to traditional credit methods and credit scoring bureaus. So the pilot will involve a sample of these MSMEs, and using digital platforms to collect or digitize data, including social platforms, and to generate alternative scoring or composite scoring with traditional credit information if it's available, to determine creditworthiness. And again, we see these pilots as, whereas they were at one point novel and exciting projects to take on as experiments, as we move out of this COVID environment, we see them becoming more and more critical to the rebounding or the recovery of the COVID period, because of the damage that will be done to credit histories during the COVID environment, and because of the number of people that will remain or that will fall back into credit invisibility as a result of this crisis. So this is an emerging area. We have good guidance from the ICCR, but we need to watch and wait and work together to leverage this kind of alternative data for creditworthiness, to bring finance to those who are underserved by it. Thank you very much for your time today, and it's been a pleasure to join you. And thank you very much to the organizers for inviting me.
Well, thank you, Mahesh, for making time out of this presentation. What would surely be non-office hours for you. Thank you for your effort. And thank you, audience. You have been a wonderful audience for the last 2 days. This was the last session from our hall. I hope you enjoyed the sessions as much as we enjoyed bringing it to you. So goodbye from here. Goodbye. Stay safe. Bye.